Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is agricultural investment expert Chris Raleigh. Now, Chris is the CEO and founder of the Harvest Returns investment platform. And over the course of visiting dozens of war-torn and poverty-stricken countries during his career as a naval officer, he began to appreciate the importance of farming to every single person on earth. Now, as a professional investor, he decided to invest in a farm, but discovered that these types of investments were inaccessible to the average person, leading him to create Harvest Returns back in 2016. Now, the company has raised more than $30 million in capital for farms, ranches, and agribusinesses in that period of time. So with that, guys, it's an honor to welcome Chris Raleigh to the show. Chris, how you doing today?
Hey, I'm great. Thanks for having me, Kevin.
Excited to have you here. Excited to peel back the curtain, pull back the curtain, and learn more about your business. But more importantly, is the story behind the business, right? And so I gave you that brief introduction there, and would love if you wouldn't mind, Chris, to take a few moments, tell us a little bit more about yourself, so we can better understand kind of what your background, what did life look like before Harvest Returns, and then ultimately what was the catalyst for you to start the firm back in 2016.
Yeah, I mean, I'll go way back, start out with kind of my childhood. My father was a real estate entrepreneur as well. He was one of the very first developers of self-storage
Oh
facilities
wow.
in Texas back in the early 70s. And so when I was a little kid, I used to spend time sweeping out units, painting, weed eating, odd jobs, how to learn that business a little bit, which is interesting because I've invested in a lot of things, but I've never invested in self-storage. Maybe that's there's some trauma from back there. But I went in the Navy, served on active duty for 7 years, got out, did some time in the reserves after that. And I worked. The very first place I went to work was as a large commercial real estate firm as a property manager, and kind of really caught the real estate bug there. Decided I'd like doing it myself rather than helping somebody else make money. So I started investing in real estate, like a lot of people start, single family homes, fixing, flipping, that kind of thing. Kind of expanded my personal portfolio there over the next 15 years or so. And began looking at land as an asset. And that's something that a lot of real estate investors have kind of become involved with for a lot of good reasons. There's that old saying, they're not making any more of it. And of course, one type of land use is for agriculture. And in fact, out where I live, it's one of the predominant types of land uses because I live out near a lot of farms and ranches. So I began to kind of dive into this. This was sort of the middle 2014, 15. And I decided at one point I did want to buy a farm or invest in a farm, not necessarily own the farm, but invest in one. And there weren't a lot of good ways to do that. So I guess I went about this the hard way, is to set up a platform for other people like me who were interested in doing the same thing. And we've had pretty good success for the past 7 or so years.
Okay. No, fantastic. I love it. Where there's a will, there's a way. So that was, roughly what, 7 years ago. And, to date, you've raised more than $30 million. So I would say that business is going quite well. I guess just a few questions that come to mind. We're talking about farmland. I mean, but that's not really, and I think that's typically where most folks, where their mind might go as far as like buying, agricultural land, or an agricultural business, but like that's not necessarily the case, right? I mean, like there's different types of agricultural investments outside of just typical farmland, correct?
For sure. And I honestly, we're not uh, the best place. If you just want to invest in farmland, there's other ways to do that. There's
Okay.
some REITs. You can go out and find a farmland broker and buy a piece of 1,000 acres, and then have a farmer pay you lease payments for farming on it. But
Well, yeah.
our types of agriculture investment are more specialized. We're one of the few places where you can invest in a cattle ranch or a livestock
Okay.
operation. And we've done indoor agriculture. Yeah, the little picture behind me, that's an example of sort of what that looks like, where you've got people that are control it in a building. So it's a lot, there's a real estate component in a
Mm.
building or a large greenhouse, and you're controlling essentially the environment, the humidity, the amount of moisture that reaches the plants, in some cases, the atmosphere, like the carbon amount of carbon dioxide, Of course, the fertilizer and all those sorts of things are all self-contained environment. So you're taking out some of the risk from what we call field grown agriculture, outdoor
Hmm.
agriculture. So there's agriculture is a really wide, as you mentioned, a wide ranging um, type of investment. We've done everything from vineyards to sheep operations to uh, large greenhouses, but also some other types of agriculture, farming and ranching enterprises and companies that support them.
Okay, well, good. I appreciate sharing that. I mean, so that's very very different than what immediately comes to mind as far as this your typical farmland. So in each one of those you mentioned like indoor, facilities such as the one behind you. You mentioned a cattle farm, a vineyard, all very different types of businesses, though, all kind of fall under that agricultural umbrella. But I guess help us better understand, um, your business model as it relates to, I don't know, pick one of them, maybe a cattle farm. Like, what does that typically look like from the outside
Yeah.
looking in? How do you identify a good investment? What does due diligence look like? And what is the overall, what's the business plan?
Yeah. So cattle, especially the types of operations we do, primarily regenerative or grass-fed, grass-finished livestock. It's a unique commodity, and really, it's not a commodity. So if you talk about corn, wheat, soybeans, when you talk about agricultural commodities, that's what many people are familiar with because they trade futures. Cattle is also part of that, but we're more of a niche area, and I'd say most of our investments are fairly niche. So what happens is a rancher comes to us and they want to say buy new cattle, or they want to improve their fences, or they want to buy some land to expand their operation, and we help them do that. We structure deals, many in many cases very similar to where you might see like a multifamily or syndication or
Hmm.
any type of real estate investment, where you've got an equity component and a debt component. We've done the equity side of deals before on cattle ranches, and we've done the debt side. And from a cash flow perspective, that debt side is really interesting, especially these days where inflation's still pretty crazy, especially food inflation,
Hmm.
and credit is tightening. So we've all seen it in the real estate space, but that's also impacting farmers as well. So with credit tightening, they're looking for alternative forms of capital, and that's one of the things we can bring while providing our investors with the high yield sort of cash flowing investment. It might be quarterly payments, annual
Yeah.
payments, that sort of thing.
So using that example again of maybe why a cattle farmer might come to you, you're looking for form of capital. Would you say that maybe given the inflationary environment and credit tightening that we're currently experiencing, that you guys actually might be in for a little bit of a growth boon at this point? I mean, are you seeing that trajectory increase at this point? Because
Yeah, we're
up
definitely
until six
seeing.
months ago, credit was easy. So why
Mhm.
would I
Yeah,
guess up until 6 months ago, why would that cattle farmer have come to you? For an
yeah,
investment, when if they had a stabilized business, they more than likely could have got maybe most of what they're looking for from
mhm.
local bank or regional bank.
Yeah. A lot of it comes down to the agriculture finance system. It's in the kind of the quirks involved in ag finance, and it's a very robust system, as you can imagine, because we've got a lot of farmland, a lot of farms in the United States and ranches,
Hmm.
but they only lend, I should say only, but it's much easier for someone who just wants to go out and buy a piece of farmland to get a loan, especially if it's row crop farmland, or to get an operating loan. Um, these conventional sorts of operation are what because that's where most of the money is.
Hmm.
That's where the ag finance system sort of grew up. It's a very localized sort of system where you've got this big sort of underwriter, Farmer Mac, and then they make these loans out to supply the capital to these smaller local ag credit unions. And a lot of farmers and ranchers use that same small ag credit union that their father and grandfather used, and they only loan to certain, people with certain amount of experience, certain, sort of risk profiles. Obviously, it's like underwriting any other asset. There's a risk profile. You have to understand it, and that's how you set the terms and underwrite the loan. But if farmers also come to us for equity, where they may own a piece, like they got a piece of land passed down from their multi-generational, and most farmers are in the country are kind of multi-generational.
Hmm.
So they might own a big piece of land, but they don't have the cattle, they don't have a lot of the equipment, they don't have the um, all the other pieces they need. So they can come to us for either debt, do it all on a single loan where they probably couldn't do. They'd have to have multiple loans with a typical ag finance, or they can come to us with equity where we will buy a piece of the operation. They can kind of develop the operation, build it out, expand it, and then at some point refinance us out. Or they might. Some of them have intentions to sell the operation when it gets big enough, but most of them want to
Mhm.
hold on to it. And so we're looking at other exit sort of strategies.
Yeah. So again, just given that you got your fingers in a few different pots here, but very niche pots. I mean, talk to me about the the backing up a little bit, the strategy when you founded the company of really getting your name out there and reaching those that would benefit from what you offer.
Yeah, I mean it's interesting because we are so nichey. Anybody in the real estate business knows there's a lot of people doing the real estate business. When we first started out, we were really the only platform, about one of the only ways to invest in farms. And since then, since we started, in rapid succession, several other kind of platforms sprung up, and they continue to there's more options out there, which is a good thing.
Hmm.
So for us, it was just a lot of kind of marketing, grinding, going out and finding primarily accredited investors or high net people that wanted to diversify their portfolios. And so we've done a lot of education. We produce a lot of content. We go on great podcasts like yours, where you've got an audience who is interested in doing something other than like just turning their uh, portfolio over to a 401k and letting it ride. People are more interested in having a little bit more control over what they put their money to.
Yeah.
Yeah.
So that's only one side of the equation, because that's obviously without the money you can't do the deals. But how about finding the deals? That's more. I guess I wasn't clear with the
Yeah,
question, but I
yeah. So the
appreciate, because
deal,
that's helpful as well. But like, yeah,
uh,
getting your I guess the service you offer, which depending
yeah,
on the business, right? Like you've got a few different options available for folks that are actually owners of the farms, right? Or want to own
hmm
a farm or expand their farm or what have you. Getting your, again, that the money takes the money to do the deal, but it also takes the deal, right? You got to put the
yeah,
two
yeah,
together.
yeah. So for us, the deal flow, we thought when we started the company that was going to be very, very challenging because we weren't really from this business. Um, we didn't have a lot of contacts in the farming industry. So what we did was we started educating ourselves. We started going to farming shows. We started figuring out what our niches were. And as soon as we were able to have a couple of successful deals and got our name out there as a source of alternative capital, the floodgates just opened. They started coming to us. And so anybody who has anything that, they're, for the reasons that I cited previously, they're trying to do something that requires some creativity and flexibility on the capital formation side, they find us, they look us up, and as success begets success. So as we started raising more and more capital, we had more and more reputable farmers and ranchers and agribusinesses coming out to us to raise money.
Got it. And what are the typical returns that you're seeking for your platform? For the different limited partners that are involved in the investment.
Yeah, so there's three primary types of structures that we've done, and they're all three different return and risk profiles. On
Hmm.
the debt side, it's generally, these days, before the interest rates really shot up, we were able to do single digit, sort of high single digits, 7-8% sorts of loans, and those were attractive to our investors. Now we have to get a little bit higher, north of 10%, to attract capital, and just be competitive in the market. And with the rate still increasing, that's kind of where we're at.
Hmm.
Um, and the maturity on those loans is anywhere from a year to say 3 years. That's sort of our typical structure, with annual payments and a balloon payment. Usually that's kind of the way it goes. But we've done some with quarterly payments and some other types of structures. So then there's equity, and that's a typical equity play where we might buy into the farming operation, and that's usually involves some sort of land or real estate component to that. And we'll structure, cash flows as the company's growth allows it. And then we've also done on some of these early stage companies. We started about 2 years ago investing in agriculture technology companies as well. So it's it's almost like an angel investing sort of thing, a little bit higher
Hmm.
risk, but a lot higher return profile. And we use convertible notes for most of those. And those are interesting because they pay a little, they sometimes have a coupon payment, and then they have a chance to grow equity as well.
Hmm. Okay. No, I appreciate that. And uh, just trying to better understand, again, this a lot of our show, a lot of our expertise, revolves around traditional real estate investments, and I'm more going from like a due diligence approach, right? Like
Yeah.
there's a lot of overlap from if I'm going to buy a multifamily property, and then I'm going to look at maybe an office property or a retail. Like there's differences in each one, and there's some unique nuances associated with each one.
Yeah.
But generally speaking, like when we're looking at an investment, like it's there's more common than there's differences, and so due diligence is
Right.
pretty straightforward. But like now we're talking about in your business, very diversified in nature, um, very broad spectrum of different types of ag businesses. And so, talk to me about the due diligence process that you guys have internally as a team, and
Mhm.
how you facilitate that.
Yeah. So, we've got our due diligence team, and I'm kind of as a CEO, I'm kind of the lead of that, to kind of make the final decisions on what gets put in front of our investors and what doesn't. Got a great background. Guys have finance backgrounds. One of our main finance person comes from an oil and gas background, but also has a commercial real estate background. So they've put together, they know what real estate structures look like and oil and gas structures, and we've taken those and sort of applied them to the ag side. And so our due diligence process kind of got an initial screen. Deal comes to us. We see about 30 deals a month. Only maybe two of them will actually make it in front of investors. And that the first screen is just, does it make sense? Is it realistic? Does it fall into sort of one of our categories of the types of
Hmm.
deals we do? And then we can kind of bin it, and then we engage with that company to raise capital. All the typical things. We're looking at the corporate documents, and instead of having rent rolls, we usually have offtake agreements. So this is agreements with grocery stores or distributors or wherever to sell the products, the agriculture products. So
Hmm.
you want to judge the durability of your revenue for the company, just like you would judge the durability of your rents for say a
Yep.
multifamily. And then we're looking at the financial pro formas, looking at if their operating history, the trailing. We've done acquisitions, so there's maybe even audited financial statements, that sort of thing.
Hmm.
And then we're looking at the team that's involved. So are they experienced? Do they have somebody experienced, not just on the farming side, but on the business side? We've seen both. We've seen very experienced farm people that have been doing it for a long time, but they're just really not that business savvy. And then we've seen very experienced business people that have absolutely no clue about farming. So we're looking for that sort of match where there's a team that balances themselves out, and can essentially execute on the plan. So that's all the kind of the typical due diligence. And, of course, we're running background checks and all those sorts of things on the team and the company.
Yeah, based on that, and I appreciate that. Based on the deal flow, again, looking at 20, 30 deals a month, like what are the more common? I mean, like the most common reason why a deal wouldn't fit in one of your buckets. Just if you had to pick one that's most common of the ones that get thrown in the trash can.
Just unrealistic expectations.
Okay, fair enough.
The pro
I guess that's
formas.
across the board then.
Yeah, it's very similar to real estate. I mean, it's
Yeah.
pro forma is just completely out of whack, or in the case of an equity, what their valuations are, crazy. That's just not realistic. So it's very similar to doing, real estate acquisition, where like the owner just doesn't want to let go, or he doesn't have a
Hmm.
realistic view of what his property is valued at.
From a limited partner's perspective, again, trying to maybe try to take an apples to apples approach. Again, for those that are just looking to make passive investments, invest in different types of real estate. Most of assuming that they have an understanding of just any type of traditional real estate investments. Like, what are some of the questions that we might have covered that are important for them to be asking, whether it be your platform or another platform that's of again critical importance of investing in ag type businesses versus that of again, traditional real estate. I mean, are there any
Yeah,
that
I
come
mean,
to
the
mind
first
that's
thing,
important to
like
hit
any,
on?
Yeah, any investment, obviously, especially these private placement investments, which, most people kind of doing it in self-directed investments in real estate are gonna be investing in private sorts of deal. I mean, you can obviously go out and buy a REIT or whatever, publicly traded, but if you're investing in these private, things, you need to understand the risk. Uh, so that's usually the first part of the when we're doing due diligence, that's the first thing I usually ask about is, do does this operator understand their risk, and can he or she elaborate on it? And then, of course, that gets baked into the disclosures and the private placement memorandum that we put out in front of our investors. But so understand those risks, and how do those risks differ from, say, real estate? It, where they're the same as there's a financing risk. You can kind of break it into categories. One we see a lot is financing risk. So and that person put together, or the team put together the capital stack they really need to complete the acquisition or the project or whatever, whatever their business plan what they're trying to do. So we might be a part of that. They might have other investors. They might have USDA loans in the case of agriculture, or SBA loans or whatever, bank loans as part of that. And does that all sort of fit together to allow them to get to where they need to be? Or are they expecting to, oh, we're going to develop this, and then we're going to build another one. We're going to raise more money. And, so the question then becomes is like, okay, are you dependent on raising more and more money, or are you dependent on becoming a profitable company? And, so that's a question we ask, especially these days, more and more often as additional source of capital continue to shrink. And then there's operational source of risk, and that's, for farming, that's disease, that's weather, that's, you know, rainfall, drought, accessibility of water, it's regulatory environment. More and more you see that. And then there's, other risks that the regulatory risk I continue to think is a growing one in this space and pretty much any business, unfortunately, right now in the United States because of the more heavy-handed approach we see to regulations these days. So whether that's, things about the environment or with this primary piece of the regulatory sorts of overreach we see right now in agriculture, but similar types of risks. So bottom line being, if you're going to invest in whatever you're going to invest in, make sure you understand risk, make sure they're disclosed, and make sure the operator has a plan to mitigate them.
Got it. Got it. Help us better understand the platform itself. I mean, minimum investment, how often are investments available? Is it a rolling type of fund, or is it just investments come out when they're available and,
Yeah, I mean, generally
get on
we'll
your list?
launch, we launch one to, the way it works, pretty simple. You get on the platform, you register, it's free, sign up, you go through some steps of qualification. We're doing primarily regulation D, SEC exemption. So for those of your viewers that may have heard the term, um, most of our investors are accredited, but we do have deals that allow a certain number of sophisticated investors. And, that's the space to watch because right now, there's some bills before Congress to change the definition of what it means to be an accredited investor, which I think will open it up potentially to a lot more people, which I think is great. So then you get on and we launch, generally 2 or so deals per month based on just the deal flow we have and the ability to process and adequately due diligence with them. And then it's kind of, it's like a typical sort of thing where everything's done online. So we're not mailing PPMs in the mail. You can sign them electronically and all that kind of stuff. Pretty typical for any sort of syndication these days. And you can decide to invest. Our deals are generally only open for like 3 or 4 weeks because we've got such a flow of them. So you're going to have plenty of opportunities to ask questions, talk to the sponsors, view webinar, visit the farm if you want to. You may not be able to do that during a due diligence process, but you can definitely do that after you've invested. And then the deal closes, you get your annual K1, you get updates, you get access to the financials, all the sorts of typical things with private placement, and then get your checks in the mail, so to speak, although it might be an ACH.
Mailbox money. Yeah. Digital
Yeah.
mailbox money. Right. Yeah. For those that want to learn more, and get a better understanding of what you guys are offering or get on your list, where's the best place to find you?
Yeah, harvestreturns.com. You can Google it. We've got social media, of course, and I encourage you to kind of dig through our content, whether that's videos or blog, a lot of blog posts, and ask us questions, register, send us an email, give us a call. We don't have chat bots. We have real people that will answer you. So love to talk to you.
It looks like you put out a lot of content. You guys are on all the major social channels, and I mean, is there, can folks expect to go maybe dig up maybe some case studies on some past deals? I mean, kind of overviews. Can you find that kind of info on maybe
Yeah, I mean,
YouTube or?
we can obviously, we've got a track record. We can show you, what that looks like if you're interested on the deals that have exited and deals that are cash flowing, all those sorts of things. We can we can talk about specific deals that we've done. We can talk about a typical deal, let's say a cattle debt deal, what the track record for those looks like. And yeah, we're all about communication and transparency. So feel free to ask.
Okay, fantastic. Well, Chris, it's been a pleasure having you here today. I appreciate you joining us.
Thanks a lot, Kevin.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Butt, wishing you huge success. Take care now.